My name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your October 2019 market update. Well, if you've been watching the news, you probably know by now that the stock market reached all-time highs over the past week. This chart shows the ascent of the S&P 500 index since 1996. And what you can see here is that we've had quite a rally since the financial crisis of 2008. The S&P 500 has returned 355% cumulatively since its low on March 9, 2009. And this return doesn't even include the return that investors earn from dividends along the way as well. And the current bull market has been much longer and the returns much higher than what we experienced in the last two bull markets, as you can see on this chart. So the length of the current expansion has been really quite stunning for investors. The gray bars here show the length in months of economic expansions, and the blue bars show the length of recessions in the US going back to 1900. And the current economic expansion has been very long indeed. At 124 months, it is the longest on record. The average expansion historically has lasted 48 months. And so the question becomes, is the current economic expansion at risk? How long can this go on? Well, it's important to note that economic expansions don't die of old age. There are reasons why this one has been so long, and part of that has to do with the strength of the recovery. A gross domestic product, or GDP, is used to measure the growth rate of an economy. And historically, the average year-over-year change in GDP growth is 2.7%, as shown by the blue line there. Well, during the current expansion, the average year-over-year GDP growth has been lower at 2.3%. So while the economy has been in an expansion for a record number of months, the expansion has been at a slower pace. And according to the advanced estimate of GDP released last week, real GDP grew by 1.9% annualized quarter over quarter in the third quarter of 2019. This beat the consensus estimate of 1.6%. And really what it did is it provided further confirmation that the U.S. economy has been slowing, but it's not stalling. And while a slowing economy does make it easier to dip into a recession, which is defined as 2 consecutive quarters of a GDP decline, or on this chart, when you see the bars go negative, that is a decline in GDP. You need 2 consecutive quarters of that in order to meet the definition of a recession. And so while the economy has been slowing, we don't think we're going to tip into recession over the next 12 months. That is not our base case scenario. In the month of October, equity markets rallied as investors welcomed positive news on several prevailing global geopolitical risks that we've been watching over the last few months. The numbers for October were as follows. The S&P 500 index was up 2.17%. Small cap stocks were up 2.63%. The MSCI ACWI ex-US index, which is a measure of the performance of international developed and emerging market stocks, was up 3.23%. Domestic bonds were up 0.30%, and the commodities index was up 2.02%. So this is interesting for the month because you saw that international emerging market stocks, finally took over in terms of strength and beat the S&P 500 out for the month. And this has a lot to do with the US dollar. So the US dollar has been strengthening rather steadily since the spring of 2018. And this move culminated in the US dollar hitting its strongest level in late September since the first half of 2017, with the dollar reverse course in October and weekend, which really helped international equities advance and outpace the S&P 500 index. So again, this just shows you the value of diversification. Some people have been frustrated that they've had allocations to international stocks within their portfolios whenever domestic stocks have been doing so well. However, by keeping an allocation to international stocks, you're able to continue buying at lower levels. And when you have months like October, when international and emerging markets outperform domestic stocks, that gives a nice boost to your portfolio and really smooths out the performance profile over time. So in the month of October, 2 developments mitigated some downside risk to equities and led investors to take a more risk-on posture and led to those returns that we saw. And in terms of a few highlights for you, first, Chinese authorities confirmed that they are close to agreeing on what is being called a Phase 1 trade deal with the U.S. And this deal would indefinitely delay new tariffs imposed by the U.S. and China would commit to buying U.S. agricultural products and enforcing intellectual property and foreign investment laws. So they're still negotiating that as of the time of this recording, but it looks like we are getting closer and closer to that. So that has certainly been a nice development for equity investors, as the trade deal has led to a few declines over the previous 12 months. Second, the ongoing Brexit negotiation provided investors with some relief, as the new UK general elections were set for December 12th and a new withdrawal agreement was struck. And so what this does is this reduces the chances of a no-deal Brexit, which I've been talking about for the last 6 months to a year. It's been the ongoing saga in the UK, and has the potential to rattle markets, but due to the developments there in the month of October, the probability of them crashing out of the Eurozone has been reduced, which is also a positive for equity markets. The other main headline during October is the Federal Reserve cut interest rates for the third time, which helped push short-term interest rates down. The Fed also signaled that this would likely be the last rate cut for a while unless economic conditions change. And so, as expected, the Fed cut rates, but because economic growth has been coming in and other data points that they look at has been coming in okay, they don't foresee cutting rates again in the near future unless something were to change broadly. So looking ahead, what do we see in the markets as we round out 2019? Well, there still are some ongoing concerns regarding the China trade situation. The Phase 1 deal is not finalized yet, so there could be some additional volatility related to that until that does get finalized. We still have negative global bond yields, a formal impeachment inquiry, which I spoke about on our September 2019 call, and still some questions about the path of economic growth going forward, both domestically and abroad. But however, other signs of economic progress continue, and the market has proved to be resilient despite these long-standing concerns. And so it was good in the month of October to finally get some sort of resolution or steps forward in terms of some of these issues that have been plaguing the market for most of 2019. We will continue to assess these situations and make changes to our portfolios as warranted. And we thank you for your continued confidence. Please reach out to us with any questions you may have.